Good evening, everyone. I hope we are all the same energy levels where we were at 8:30 p.m. or rather 8:35 p.m. yesterday evening. I can see a lot of excitement already on the query panel. Good evening, Kiran, Ajay, Sushil, Bhumika, Shweta, and everyone else, Kadambari. So we have back-to-back sessions, and good that we have back-to-back sessions because it helps us to ensure the momentum with us, and we have to cover a lot in terms of the concepts, especially when we talk about whatever we have done yesterday. We talk about capital budgeting process. We talked about why investment decision is important. We discussed about the some decisions based on the firm existence or routine decisions, and then we also discuss the relevant cash flows, the factors we need to consider with respect to cash flows, depreciation, tax shield, relevant cost, opportunity cost. We moved on to then understand the stages of the cash flows, including the working capital requirements at various stages. And then we moved on to the evaluation techniques. So, two broad categories. One was discounting, and one was the non-discounting. In non-discounting, we had discussed the payback period and ARR, and discounting techniques. We had discussed discounted payback. We have discussed NPV, profitability index, and IRR. So, kind of good coverage in terms of concept. And today we will be continuing from where we left, and we will be focusing at least in the first hour or so with some more issues with respect to concept, and then we'll move on to a lot of practice, guys. So very warm welcome everyone back again here on this forum, and we kind of let me just kind of join the thread first. I think towards the last 10 minutes, 15 minutes, we were discussing about the IRR, right? We talk about how the IRR gets calculated, how we talk about the selection criteria for IRR, and we also discussed about uneven cash flows or even cash flows. In even cash flows, we could straight away get a present value annuity factor, which could be, referred to the annuity table. In case you do not get that same factor, we can pick the two rates between which the that particular factor lies, and then we can calculate the two NPVs. But if there are uneven cash flows, we have to start with a random rate, right? A random rate, and the NPV with the first random rate will decide on whether the second random rate will be higher or lower. Okay. So before we move on, Bandi says, please upload the notes in app. Bandi, this was already uploaded day before yesterday. Just please check. We have already uploaded the entire file. Guys, anyone else can confirm, please, on the query panel? The notes were already uploaded, and I announced this yesterday also that there are a lot of questions for practice in this particular file, which which will be more than what we are doing in the class. So there are a lot of questions for your practice as well. So guys, I request everyone to confirm if you have. Yes, thanks, Akash. So guys, please, those of you who have not seen, make sure that you guys kind of download it later on. Okay. So before I start, the first question I would like to ask from you guys. Let's see how many of you are active, very much high in Josh. Uh, when we talk about uh, IRR, that means the rate at which NPV is zero, which is lower than the desired rate of return, should we accept the project? Should we reject the project? We got an IRR of a project. That means the rate at which NPV is zero, and that IRR happens to be less than the desired rate of return. Should we accept the project or reject the project? That's for the first question for everyone. Based on yesterday's discussion, of course. Okay. First two answers I got is absolutely north and south. That's what I want actually. But when I see the majority till now, what I'm seeing is, let me just wait for others also. I think majority is kind of telling me it has to be rejected and more rejected. Why? Because I told you guys, if we are talking about IRR, is the rate at which NPV is zero. It where the project NPV zero and it is less than desired rate of return. So if I have to calculate NPV at the desired rate of return at a higher rate, the NPV will be negative. So you will be rejecting rejecting this, right? So So let me do one thing, kind of give you an example on this evaluation criteria at least. Give me a second. So we were discussing about the evaluation criteria yesterday. So let me take an example what I just said. This is purely an example, guys. Let's say let's say my rate of return, desired rate is 10%. And let's say we are talking about IRR comes out to be 8%. Now, if I talk about the the NPV at 8% and at 10%. So of course, if I IRR 8%, at 8% the NPV will be zero. But if I calculate the NPV at 10%, that means I will be discounting the cash flows with a higher rate. This will automatically become negative, right? So that means it should be definitely rejected, guys. Okay. Then one more question to start our day, and this is one of my favorite questions, guys. That's coming your way now is this one. Let's see. Based on IRR, this is a very good question. I request you guys do not hurry. Think it over, evaluate all the four options, and tell me what exactly, where exactly you think the answer should fit in. The call of the question is which of the following events would decrease the IRR of a proposed asset to be purchased. The call of the question here is which of the following would decrease. I can give you a hint to answer this question is what you all must have studied in your economics, something called as a ceteris paribus, other things being constant. So when you evaluate these options, make sure you consider only that particular factor into consideration, and everything else remains same. Don't make other changes. So evaluate each options independently. So let's see what is the first answer coming up. And I request you guys to give the answers by calculating and not referring to the notes, right? It's better that you are giving your own calculations. I think I'm getting again two answers right now, but I'm expecting that more options would be there with the students. I think this is a very interesting question because I have my reservation. Those of you are even giving the right answer, whether you are evaluating that right answer for the right reason. That's another interesting fact. So right now, till now, I can see answers from Srinivasan, Manish, Ninad, Gajendra, Tanishka, Sahil, Anirudh, Kiran, and Bhumika. Thanks, Anirudh and Bhumika. I wanted that students should give me answers for all the four options. Now, I will like to start discussing this question here. And I've got all the four options. I guess it's like just like the option number C is something which is okay. One option C is also there now. Very nice. So all the four options are there. Let me start with option number D. Use written down value method instead of straight line method. Guys, do you agree with me that depreciation under WDV would be more than depreciation would under straight line method? And if that is the case, that means tax shield will increase. Tax shield will increase. If tax shield will increase, cash inflows basically will go up. And if I talk about the IRR is the rate, IRR is that rate at which the NPV is zero. So we are saying that present value of cash inflows minus initial investment has to be zero. That's what we are saying. Now in option number D, if my cash inflows is increasing, so what's happening is if my cash inflows have to be discounted like this, and I'm saying that my cash inflows are increasing here, the cash inflows are increasing. That means for getting this as zero, other things being constant, right? There is no change to initial investment. Cash flows are increasing. So for making sure that the for the IRR NPV has to be zero, the rate here will go up. Rate will go up. because we have to arrive at zero, right? NPV is zero at IRR. So this will actually result in considering that there is no change in initial investment, this will actually increase the rate of return here. The question was decrease, and hence we can safely say that this is definitely not the right answer. Option number D is cross. So some people said option number D. I hope it is clear that option number D cannot be the answer. Some people are very, very sure that answer is C here. So let's talk about C. Shorten the payback period, guys. If I say shorten the payback period, what does it mean? Do you agree that the cash inflows in earlier years, in initial years, is more now? Will increase? Cash inflow in initial years will increase? Don't you think if that is the case, considering there is no change in the initial investment, again the rate will increase because I have to make my NPV zero. For NPV to be zero, my rate will go up because my cash inflows in the initial years are going up because I have to arrive at NPV at zero. So the same reason for D and C. If D cannot be right, even C cannot be right, guys. D and C both cannot be right answers. I hope everyone is with me on this while we are discussing. Okay. Srinivasan has a very, very interesting point. See, he says that, and Srinivasan, it's a very, very good, honest statement here. Srinivasan says that I have taken a calculated risk as other three options are not correct. He's trying to say that that's a B, C, D. I'm very much sure that they're not correct, but I'm not 100% sure that why A is correct. So, Srinivasan, that's a very, very honest statement. Very good. Uh, we're talking about option number B now. Decrease related working capital requirements, guys. Decrease related working capital requirements. Now, what happens for option number B? Let me discuss there. Option number B. We're saying that, okay, cash inflows multiplied by 1 plus R to the power n minus initial investment has to be 0. If I am having related working capital requirements are going down, that means this is going down, right? Initial investment is now going down. Option number B may initial investments are going down because capital work, working capital requirements are going down. Now that means my NPV will be becoming positive. To make sure that it still remains zero, there is no change in cash inflows here. I have to increase my R again. I have to increase my IRR again. I have to increase my rate of return because I have to discount so that my discounted cash flows become lesser so that NPV is again zero. So that means option number B is also gone. So B, C, D are absolutely gone out of the box. And that means the correct answer is what initially I think almost 6 to 7 students were pretty much on the trot, option A, option A, option A, but why option A? Let's discuss this now. Let's discuss why option A. Let me make some space here. So option B, C, and D are not right. And this is very, 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 very good analytical question, guys. And I'm sure all of you agree. This is not a straightforward question. You have to apply your logic. You have to understand the IRR methodology to actually attempt it and attempt it to your satisfaction. So we are left with only one option, that is decrease tax credits on the asset. Let me again write that equation. IRR is the rate at which NPV is zero. Hence, we are talking about cash inflows discounted minus initial investment. Of course, if there are more outflows, we can have present value of cash outflows also. That's okay, is zero. Now, decrease tax credit, guys. What is tax credits? Tax credit is kind of a rebate granted by a government or a relief in taxes. So if the government takes back some incentives, government takes back, they're decreasing the tax credit. Don't you think my initial investment will increase, guys? Do you agree with me? If the tax credits on the asset means which is to be purchased, let's say the asset which is purchased and government has decreased the tax credit, that means I have to spend more now. Let's say earlier, let's say a particular machinery was costing 25 lakhs because there was a rebate, but now it is costing 26 lakhs because government has taken back that benefit. So my initial investment will go up. My initial investment will go up. There is no change in the cash inflows. Now NPV seems to be negative here unless I lower down the rate. NPV could be negative, but if I lower down my rate so that my discounted cash inflows are higher to make NPV zero, that's why option number A is the correct answer here. I think we're starting the session with a real brainstorming question. I guess probably you guys might agree, and very aptly the cartoon on the top kind of reflects your mind situation right now. Each and everyone here is like having a light bulb on in their minds, in their brains, right? So Rehan says tax credit and ITC are same. You could say that. You could say that. Any kind of a tax benefit, Rehan. Any kind of a tax, any kind of a tax benefit. Don't confuse that it is only GST credit. Any kind of benefit. Tax credit means like they are providing you some benefit and they are taking it back. Guys, everyone okay with this question now? I hope the question, you guys like the question, you guys appreciate it. Yes, how the option number A. See, getting the option number A is one thing, but why option number A is the right answer is another thing, right? You're getting to the whys of the things now. Why we are talking about. Okay. Okay, let's move on, guys. Now, my point here is we discuss NPV and IRR. Of course, if I ask you that, okay, which is the better method for evaluating the capital budgeting techniques, discounting or non-discounting, we are talking about is obviously the discounted methods is a better method, right? So NPV and IRR both are good, right? Srinivasan says, can you please explain once more time, please? Srinivasan, you tell me, if government takes some tax credits back, government was giving your, let's say, relief of 100% taxes, but now they're saying that okay, we give relief of only 50% taxes. So initial outflow will increase, na? Your initial outflow is increased. Let's say your initial outflow was 20 lakhs. With that credit being taken away, now initial outflow becomes 22 lakhs. Now, for this number, for the present value of cash inflows, mind you, your NPV has to be zero. The present value of cash inflow has to increase, and and cash inflows here are not changing. So only thing I have to change is reducing my rate of return. So Srinivasan, I hope it makes sense now with the explanation at the bottom right in front of your screen. Okay, guys. So now I want to move on with the fact that you all agree with me that discounted methods are much better for evaluating capital budgeting. Yes or no? You guys agree with me? And we already saw some conflict. Okay, again, question coming in, Srinivas, how it will decrease IRR? Arre, Srinivasan, you tell me, if I have to increase the present value of something, what do I do? Srinivasan, if you have to increase the present value of something, what do I do? I have to lower the rate, right? That rate is IRR here. We are calculating IRR only, na? Think it again. Okay, let's move on now. So yeah, so we're talking about we already saw that there was a conflict between NPV and profitability index. One was absolute measure and one was a relative measure. Let's see if anyways, if there could be an issue with IRR itself. Let's talk about this. Up till now, IRR is like working very well when you have a initial investment, like outflow at the initial stage of the project. But what if there is a project where there are outflows at multiple stages? Then we may have to calculate different IRRs. We have to calculate multiple IRRs. Let's see this. So we start our session with a point which talks about issues with IRR here. We're talking about issues with IRR. So where we are looking at a mutual exclusive projects would create problems with IRR technique, because here we are talking about a percentage and does not take into account the scale of investment or quantum of money earned in absolute terms. So like similar thing like we discussed for profitability index and NPV. Like there we were talking about a ratio versus a absolute terms. Here also we're talking about percentage. So let's say a project A and B. Okay, project A and B. We're talking about, let's say, NPV. NPV of project A is 40,000. NPV of project B is, let's say, 56,000. IRR, let's say this is 10% and this is 9%. You have conflicting decisions here. You have a conflicting decisions. IRR says project A, NPV says project B. So of course, the idea here is that the IRR doesn't take into account the quantum of money earned in absolute terms. So there could be a scenario where a project with a larger firm commitment but lower IRR that could contribute more in terms of absolute NPV, like we said, right? Absolute. So even if it is a lower IRR here, 9%, you're getting more return, and hence your shareholders' wealth will be increased. So in that case, so I will always say that, okay, although IRR and NPV are conflicting, NPV method may always have a slight edge over all the other methods, net present value, right? uh, when the projects have a similar capital outlay, then profitability index could be even better, right? Now, the second point here says where the project cash flows change signs or reverse during the life. That means there is an initial cash outflow, there are some inflows then, and then let's say around fourth or fifth year, you will have another cash outflow. Let's say a particular project has 10 lakhs as an outflow initially, and then after 3 years. So in that case, when you're calculating the IRR, mind you, we're talking about the calculation, the rate at which the NPV0, we have to calculate the initial investment only. Hence, we are talking about, we are only considering the first outflow, and then we are calculating the second stream of outflow with respect to subsequent returns. So we may have multiple IRRs then. And then, of course, we have to be considering that if the cost of capital is more or less than both the IRR. So this is a very, very tricky situation. We will talk about this, how to tackle these situations. We'll talk about this. Right now I'm just discussing that, okay, what could be issues with IRR. We will discuss how do we tackle this. Now, one thing which could be relevant for you guys for your MCQ specifically, friends, here is a reinvestment assumption. Now, under both the NPV and IRR methods, there is a reinvestment assumption. What is reinvestment assumption? The funds generated by the project are reinvested in the business. And the way we are calculating the NPV, there is an assumption going behind the curtain. What is that? NPV assumption is that all the cash flows are reinvested at discount rate, which is being used to calculate the NPV. Like it could be WACC, it could be the hurdle rate, which is absolutely logical. But IRR would assume that the cash flows are reinvested at the project's IRR. Now, because you don't know any other rate, right? In IRR, you are only calculating one rate at which NPV is zero. So that means if that is the case, IRR will always favor the projects which have higher returns in the earlier years. I think this is a little bit of a theory. So let us do one thing. Let me show you some conflicting situations here. And then you guys will understand what are the conflicting situations. Before we go to the modified IRR, let us see this. What could be the situations where NPV and IRR are giving some conflicting scenarios. The first one is size or scale of the disparity, or that's what we were discussing, that IRR is a relative measure, NPV is an absolute measure. So you could see that project A is giving you higher IRR, project B is giving you lower IRR, but in terms of the absolute measure, project B is having a larger investment and giving you a larger NPV. So NPV, as per the NPV, it's project B, as per the IRR, is project A. So it's definitely a conflicting decision here. Similarly, the point we were just discussing, the point which relates to the reinvestment assumption, we are talking about a situation where uh, you will have some projects wherein there is a more inflow in the earlier years. So we're talking about a reinvestment assumption. So that means the cash flows may be, overall cash flows may be more or less in both the projects, but there could be a disparity in the timing. That means in one of the project, cash flows could be higher, higher cash flows could be in the earlier part of the projects. If you see here, in this example on my screen, project X and project Y have very similar outlay, 2.5 lakhs, 3 lakhs. But you see the returns, guys. Just see the returns with me. Both the projects are giving you 3,50,000 in returns, right? Or rather, first one is 3,50,000, second one is giving you 4,50,000. But in the second project, your outflow is also higher. But if you compare the project X and Y, what is your observation? Project X is giving you returns in the earlier years, and the project Y is giving you the return in the third year, right? Return in project X is in the earlier year, in the first year itself, but in the project Y, the return is in the third year. But the overall returns are higher overall returns are higher in the case of project Y. And that's why you could see that NPV is kind of focusing on project Y, but IRR is very significantly focusing on project X. Why? Because of the reinvestment assumption. It will always favor the projects with early return, with early return because of that. Everyone with me on this? Everyone okay, guys? Till now, can I get a quick confirmation on the query panel? Now, there is one more scenario where you could have a conflicting decision with NPV and IRR. The scenario here is we talk about the projects with different lives. So like you can see right now is project X is having is only 1 year in terms of tenure. Project Y is having a 3 years in tenure. You could see that project X is having a 50% IRR straight away, and project Y is having a 43%. But you could see the NPV is significantly higher for project Y. Now, what do we do? Taking a decision based on one of these could not be very logical, because we are not doing, again, my favorite statement, right? We are not having an apple to apple comparison. The good point would be like, let's say we talk about like till the time the project Y is taking 3 years, can we have three different smaller projects, project X to be repeated 3 times? So this is something which we will be discussing as one of the additional concepts here. That's something called as a replacement chain method or equivalent analyzed criteria. We will talk about these methods later on. That if there are projects with unequal lives, we have some techniques that could be equating the comparison in much better fashion like this, right here. Otherwise, just with looking at NPV and IRR, you will definitely have a conflicting situation here. But before I go to the other methods, before I talk about the situation where we have this replacement chain method or annualized criterion, I would like to just quickly cover one extension of IRR. Extension of IRR. The extension of IRR in terms of the shortcoming. We had an issues with IRR, guys. We talk about the second point, where the project cash outflows are not only in the initial year but also in the later years. We have an answer for that. For that, the answer is modified IRR. The term is modified IRR, modified internal rate of return. Now, this is also called as a terminal value method. Terminal value method. And that means there is a limitation attached with the conventional IRR, right? Which is the assumption of the reinvestment rate issue, where you could have a situation where you have a multiple cash outflows and you may have more than one IRR. So what you will do now what you will do is rather than discounting, you will compound all the cash flows, whether inflow or outflow, apart from the initial investment, to the terminal value towards the end of the project using the discounting rate. So what we are doing here is, let's see, there is a project which requires initial 50,000. Then you have a inflow of 20,000 for 5 years. And right here, there is another outflow of 20,000, right at the center of the project. So what we're doing here is, in this particular case, we will compound all these cash flows to the last end of the project, except for the initial investment. We will not compound the initial investment. We'll compound. We're not discounting, guys. I hope you don't forget your compounding and discounting, right? In your schooling days, you all have learned a compounding formula. A is equal to P into 1 plus R to the power N. That was a compounding interest formula, by the way. And who would have thought that simultaneously you are also learning the present value concept in the school? Why? Because if you just swap this formula like this becomes your present value. So we all have learned compounding in the school days, but now I'm telling you, you also learned the discounting. Both the things were inadvertently taught while you guys were in school or in your earlier years of education. So here we are talking about compounding. So if I compound, right, think it that way. If I am compounding all the cash flows except for the initial investment to the end of the project, what do I have at the end of the day? I will be left with two numbers. I will be left with only two numbers. One will be initial investment, and the other number will be compounded value of all the cash inflows and outflows towards the end. Like whatever, like 5 years ke andar, whether we would have annual cash inflows or some outflows or some working capital, whatever, except for the initial investment, we are the compounding everything to the other side of the river. So let's say there is a river, right? You are on this side of the river, and the compounded cash flows are on the other side of the river, right? So what we do is you are left with only two numbers now. Only two numbers. So what's the catch here? MIRR is obtained by assuming a single outflow in the zeroth year and a single stream of terminal cash inflow. Because why single stream? Because you have just compounded everything. We are talking about the compounded amount. So you have compounded everything. It is a discount rate which equates the present value of terminal inflows to the zeroth year outflow. I think it is good to see this with the help of an example, right? It's when you add numbers to the words, the meanings get more clearer, right? So let's discuss this example so that everyone is pretty much comfortable. So let's look at this illustration at the bottom. An investment of 1,36,000 yields the cash inflows, that is profit before depreciation but after tax, of 30, 40, 60, 30, 20 in 5 years respectively, and determine the MIR considering the 8% cost of capital. So what we're doing is we're calculating the MIR. So you can see we are kind of compounding everything. We're kind of compounding everything. 30,000 compounded for 4 years. Why? Because we are talking about at the end of the 1 year, we have to reach the fifth year. So 4 years remaining. 40,000 compounded for 3 years. 60,000 for 2 years. And the last one is not compounded. And you're getting a 213,587. So if I want to draw a number line here, let me draw a number line. So that you guys understand the context here. So originally we are having a investment, right? Investment of 1,36,000 here. And then you have a 30K, 40K, 60K, 30K, and 20K. That's the original scenario. Once I've compounded everything, what I'm left with is 1,36,000 here, and I'm left with 2,13,587 here. We are left with only these two amounts. Why? Because we have compounded all these numbers towards the end. We have compounded all these numbers towards the end, guys. I hope this makes sense to everyone. Right? So now what we are doing here is that IRR would be the rate. IRR is that rate. What we do is 213,587 into, so, or let me put it that way. Let me put an equation guys. A step. If I am left with only two numbers here, 136,000 and 213,587, can I say, applying our same logic, that A is equal to P into 1 plus R to the power N, that is 213,587 is equal to 1,36,000 into 1 plus R to the power N. Can we say that? Is that what we're trying to say? Or no? What do you think? Logic? Any logic, guys? Are you guys clear on this? That means by definition, we are saying 1 plus 1 plus R to the power N is 136.213587. That means we have to find a discounting factor for 5 years At what rate it becomes 0.6367? So my number is 0.6367. That means we have to see in the annuity table for 5 years, what is the rate approximately to 0.6367, and the answer comes as a 9% here. So that means, do you agree with me? Do you agree with me that this should take care of the multiple cash outflows? Because what I can do is, let's say in the same question, guys, in the same question, I do a slight modification that in the year three here, we have an inflow of 80,000 and we have an outflow of 20,000. I'm just kind of slightly modifying so that net we have 60,000 cash flows. So we are discounting everything now, compounding everything to the fifth year. From the first year, from the time zero, from the T0, we are kind of compounding everything to T5 here. Okay, guys, Srinivasan, Kiran, Gajendra, Dharmisha, all doing good. Bhumika, I hope everyone understood the MIRR. So this takes care of the scenario where if during the project you have multiple outflows also, that can be also compounded towards the end. Only thing you need to be very, very careful is only one amount need not be compounded. That's your initial investment. Initial investment need not be compounded. Everything else is. Okay. Very nice. Super. Thanks for the confirmation, guys. So now we talk about one more scenario, guys, uh, which we discussed yesterday towards the starting of the capital budgeting. I think one of the reasons you guys told me why the capital budgeting decisions is important. Like there were a lot of reasons we discussed, right? A long-term project here, there cannot be a U-turn, or you will be incurring a big losses. I think one of the reason was that the capital is scarce, right? Capital is scarce. And till now, whatever we have discussed, that okay, NPV looks to be a good decision making method, and you will say that okay, if I'm evaluating the projects, right? Let's say I have 5 projects, right? And this is question to everyone here. Let's say I have 5 projects, and I'm calculating the NPV of 5 projects, and let's say 3 projects out of those 5 will be a positive NPV. What do you think? Should I go ahead with all the 3 projects? Manish has a question, more than one outflow. Manish means in the year 2, 3, 4, 5, if there was an outflow, negative sign. So that can also be compounded towards the end along with the inflows, right? More than one outflow is like initial investment where there is an outflow and there is a subsequent. Like, remember a question we did yesterday where you had a sales and promoting expense in the second year? Tanishka says, what is the difference between IRR and MIR? Tanishka, we have just discussed, right? The both are giving the rate at which NPV is zero, but the calculation methodology of MIR is different. That MIR is compounding all the cash flows to the terminal year and then calculating the rate. The logic is same though. Bandi says how to ask this type of question exam. Bandi, you can talk about a similar illustration, right? If they're talking about multiple cash outflows and they're asking you to calculate MIR, that's the logic, nothing else. Okay, I'm asking my question, guys, again to everyone. My question was, if you are having a 5 projects and we're calculating the NPV of all the 5 projects, the 3 projects give me a positive NPV. What do you think? Should I go ahead with all the 3 projects? That was my question to everyone. Should I go ahead with all the 3 projects? Bhumika says we should choose the project which is giving higher return. So Bhumika, I'm just slightly altering your answer. You mean to say that which the project is giving you highest return, right? Anyone else? Anyone else? Uh, you're saying Srinivasan says if all the projects combined is positive, then accept the project. Okay. Okay. I think directly or indirectly, are you guys even thinking on the lines? What about availability of funds? Yeah, Ninat says that. Manish also says that. If there is no constraint on resources, right? So that's what my next agenda here is. We are discussing capital budgeting under capital rationing here, guys. Capital rationing. So that's what we are discussing right now. That what if you have availability of funds? If not, you might have to consider, okay, how do I select 1 project, 2 projects, 3 projects, right? So I think everyone understands that there is a general rule: projects with having a positive NPV should be accepted because the idea is wealth maximization. But the problem is generally you will have a scarce resources, you have limited funds, and firm may have to select only some of the projects amongst the projects. So, for example, let's say there were three positive NPVs, we may be able to select only one or two because of the capital limitations. We may not be able to do all the three projects. Now, then comes a very, very interesting situation. Most of the times, you will either have to accept the entire project or reject the entire project. That means what I'm trying to say is most of the scenarios, you will have projects that are not divisible, projects that are not divisible here. Sometimes you could have a situation where a project, hypothetically speaking, at times, what if the project is divisible? How can a project be divisible? Let's say you take one part of the project, another company is taking another part of the project. That means you are able to take like 20% of the project or something like that. You can take one part of the project if the project is divisible, part project is possible. Now, why I'm telling you this is the decision criteria will depend on whether the projects are divisible or not. If the projects are divisible, which is unlikely, but we can't say that it is impossible. If the projects are divisible, the projects should be ranked based on NPV per rupee of capital method. That means we have to calculate NPV and then we might have to divide something by the initial investment also. NPV per rupee of the capital, let's say NPV divided by initial investment. We'll see that, don't worry. And most of the times where the projects will be not divisible, then you have to simply rank on the basis of absolute NPV. And you will pick the projects wherein, at what point you are talking about a maximum possible NPV. Now, this is also very, very interesting, guys. Let's say you have, again, I'm giving you the same example. Let's say five projects, and they are non-divisible, not divisible. Let's say project, the rank number one project gives me an NPV of plus 20,000. Project two gives a plus NPV of, let's say, 14,000. And the project 3 in the rank is giving me plus 9k. And I'm saying that there is a scarce capital scarcity. I'm saying the project is not divisible. And we are ranking as per the absolute NPV. Let me also give you the other four projects. Let's say the fourth project is giving you plus 3k. And the fifth project is actually giving you the negative NPV. So that means fifth project is gone out of the contention, if that's the case. Gajendra says, choose the project with the highest NPV. So Gajendra says that we can select option number 1. But think it loud, guys. Let's say, let's take an example that project 1 requires an initial investment of 10 lakhs. We have 10 lakhs only. Project 2 requires, let's say, 7 lakhs or 6 lakhs. Project 2 requires 6 lakhs and project 3 requires 4 lakhs. Now you might wonder that why can't we, instead of going for the project 1, we can actually select project 2 and 3 if we have funds for those two projects, because combined NPV will be higher. Combined NPV will be 14 plus 9, 23,000. So why I'm giving you this example is because we are saying here is that we are ranking the projects in the NPV. That's absolutely correct. But at the same point, if we are able to select more than one project, you have to select that combination which gives you maximum NPV until your resources are exhausted or you cannot pick any other project. Is everyone okay with that example that I am giving you scenarios in front of you that there could be a possibility that you are not going with the number 1, but you're actually going with a combination of 2 and 3 that exceeds number 1. Right? Shweta, absolutely correct. Gajendra, Manish, Bhumika, I hope Tanishka, everyone doing good. Okay, with that thought process, let's also look at the illustration on this in this slide at the bottom. Parvati Limited is planning capital investment program for the next year. It has 5 projects, all having a positive NPV. Very nice. There are 5 projects in this example, all are having a positive NPV. Company's cutoff rate is 15%, so probably they would have calculated the NPV at 15%. Investment outflows and present values are all in thousands, and the company is limited to capital spending of 1,20,000. So let's have a look at the scenarios here. So let's see this. We have to calculate or illustrate the returns from the project within the capital spending limits. And we also saying that, okay, the projects are independent of each other and are divisible. The projects are divisible. That means part of the project can be taken here. Very interesting. So we have 5 projects. How much funds do we have? I think we need to mention somewhere 1,20,000, right? So in our pocket, we have 1,20,000, 120K. Let's mention that with a pen which is more legible for everyone. So 120K is with us. And I'm seeing different investments here, 50,000, 40,000, 25, 30, 35 in all the 5 projects. And I think with the naked eye, I can see I can pick minimum 2. With the naked eye, I can see minimum 2 projects. I could pay, with the projects being divisible, I could even pick a third one or part of the third one. I already have this in my mind that this is what everyone can evaluate. Now they've given NPV, guys. NPV 15.4, 18.7, 10.10, 11.2 and 19.3. Now with the divisible projects, guys, what do we need to calculate? I think with the divisible projects, what we need to calculate is NPV per rupees 1 invested. So what we're doing here is 15.4 divided by 50. Similarly, 18.7 divided by 40. 10.1 divided by 25. So we are calculating NPV per investment, right? NPV per 1 rupee invested. So that means if I see that, I think if you look at logically, if we were looking at NPVs only, I think the maximum NPV was of project E, that is 19.3. But when I'm seeing this NPV per 1 rupee invested, then also it seems to be project E. It continues to be project E itself. However, you need to understand that all the projects ranking may not be the same. If you see the ranking as per the project's absolute NPV or as per the per rupee investment is not the same here. The sequence gets changed, especially with respect to the third ranking. First and 2 are same, project E. So both the methods are saying E is number 1 and B is number 2. But if you look at the third ranking, as per the absolute NPV, third ranking was with project A, whereas here now, as per the per rupee invested, is with project C actually. So my relevant point to start with, division criteria will depend that you need to ask yourself, hey, whether the projects are divisible? Yes, they are. Projects are divisible? Then please select on the basis of NPV per rupee invested. You have to select on the basis of that. And that means in this case, I'm talking about project E. So let's discuss this solution now. How do I go about this, guys? If I see my remaining funds is let's say 500 with me, right? Sorry, 120K. So 120K I had. As soon as I select project E, 35 is gone. So I am having 85K with me. The next in ranking is project B here. Project B is the second number. So as soon as I put 40 here, I'm left with 45. This is remaining wallet. You can say that your remaining funds or remaining wallet or your purse. The next in tracking in C, guys. C is giving you another, requiring another 25 investment and only left with 20K now. And we are left with 2 projects, D and A. Mind you, you can very well see that project D requires 30,000, but you are left with 20 here. But since you can do the part of the project, that means you can do 2 by 3rd of D here as well. So you are saying E, B, C. You're saying that E, B, and C right? 2 by 3 of D can be taken as well. What do you think, guys? Everyone with me on this? Everyone okay? So the answer here is E, B, C, and 2 by third of D as well. So my investment decision is we're saying E, B, C, and we are also selecting 2 by third of D. When the projects are divisible, Shweta, I hope you are with me on this. So 2 by third of D is also possible because the projects were divisible and you were left with 20,000. Very nice. What about others? Kadambari, Tanishka, Srinivasan, everyone doing good? It's a very, very good example just to make sure that you understand the concept. Also, guys, one more thing is we can do a slight variation here. What is the variation? Like, what if we say that question part B here, what if the projects were not divisible? Srinivasan, that depends on the project contract, right? As I told you, right? Sometimes the project is in different stages. Let's say you talk about construction, you are only talking about the structure and not anything else, right? So it can be worked around. Some projects have situation where you have multiple vendors involved. Absolutely correct. Yeah. So I'm talking about option number B here. What if the projects were not divisible, guys? What if the projects were not divisible? I will be going with the NPV ranking. NPV ranking if it is not divisible. So I will definitely go with E. So look at this. If you see E, B, and A, if you see NPV ranking, E will take your 35, B will take your 40. But if you look at option number A, you don't have enough funds. You don't have enough funds here for A. You're already exhausted 75 here. So not enough funds for E, B, and A, whereas E, B, and D would give you a higher NPV of 49.2, right? So we have to consider that combination. We can go with E, B, and D. E, B, and D, you have funds because E may you will be having 35, B 40, and D 30. So total requirement here is 105. You still have 15,000 with you. So you don't have the enough funds for the best combination, but you have good funds for the next best combination. But the difference here for everyone is if the projects are divisible, you have to select based on the NPV per rupee invested. If the projects are non-divisible, you have to simply select the based on the ranking of the NPV, guys. I hope the illustration is completely clear to everyone. Everyone clear here, guys? Okay. Now we move on to a situation, guys. So there is a homework here for everyone. There is a homework which I want to give you guys. A situation which is with respect to testing yourselves, which is in your notes. So try this on your own, right? Shweta says if projects are not divisible, why not E, B, and C? Why not E, B, and C? E, B, and C. Because E, B, and C, your combined NPV is lesser, Shweta. E, B, and C. I know why you are saying E, B, and C. Because you are kind of having another combination, right? So I would always go in the ranking, right? If not E, B, and A, I will go for E, B, and D and then check E, B, and C. So in E, B, and C, if you see at the bottom, it will give you a lesser NPV of 48.1. So you check the combined NPV, please. Right? Okay. So this is a homework for everyone, guys. This is a homework as in you guys have to try yourself by calculating by ranking the based on the NPV and also the NPV per 1 rupee investment. This is something you guys can try later on. You have answers also, but I request you guys to please check at your end, do your calculations, and then compare what is your evaluation here. Now, I would like to talk about a very, very interesting aspect. Remember the NPV and IRR conflict? Remember the NPV and IRR conflict? In one of those, there was a situation of projects with unequal lives. We had a project X for 1 year, project Y of 5 years. What do? We discussed couple of methods over there. We talk about couple of methods over there. So while evaluating the proposal for projects with unequal lives, you are discussing, issues like retaining an old asset or replacing it with new one, choosing one proposal with another. And these situations can be pretty much solved by these two methods, replacement chain method or equivalent annualized criteria. So let's discuss these one by one, guys. Replacement chain method, one of my favorite, reminds me of I think the mathematical concepts of your school days of LCM and all that, right? I don't know how many of you remember that, HCM or LCM and something like that. So what is replacement chain method? It involves repeating the shorter projects multiple times until they reach the lifetime of the longest project. Longest project. Obviously, it is an assumption also. Let's say we talk about project X is of 1 year, project Y is of 3 years. You're saying that you will you if you have to compare the two projects, you have to repeat the project X three times and do the project Y one time. But my question is, will the project X be available after first year again? Again, that's an assumption here. Obviously, we're talking about like the shorter life project. Or similar opportunity can come again and again. You can say that, right? So repeating the shorter projects until they reach the lifetime. So obviously, this is something which is applicable when there is a situation you have a project life in multiple of each other. So if I change this scenario, let's say project X is of having a life of, let's say, 2 years, where the project Y is 7 years, guys. So that means you cannot go with this unless you kind of make sure that you repeat the project Y two times for making it 14 years, and you multiply the project X 7 times. So again, don't go actually to the LCM route. What we're trying to say here is that this is applicable where size of one project is in multiple, like double or triple of the other. So for example, with the repetition, that could be equalized. So again, giving another example, let's say project X is taking 6 years, project Y is taking 3 years. Very realistic example. So that case, what we do is you will absolutely calculate NPV of project X at one point, and then you can basically do one thing is, let's say if you're talking about project Y here, so project Y will be happening here, and again one more time here. So you will be calculating the NPV for project Y two times and project X one time. So that will give you a replacement chain method, and then you can compare whichever method gives you the highest NPV. You can select that. Let me do one thing. Uh, okay, let's kind of, before going to the equivalent analyze criteria, let's try to discuss an example on the replacement chain method, guys. Let's first discuss the example here. Dhoom PLC is considering modernizing its production facilities, and it has two proposed considerations here: expected cash flows in thousands associated with these projects, and their NPV of 12% and IRR is all given to you. So let's see what's happening here. Can you see project A is spreading to 6 years here? Is with only look at the first two rows right now. Project A is giving you NPV of 649 and IRRs of 17.747, but project B is giving you IRR of a 25.2, NPV of 515. That means, is it a conflicting decision? Yes or no? Is it a conflicting decision? IRR is always favoring the projects with a higher returns or early returns, or a projects with a shorter life. Do you see that, guys? Project B is recommended by IRR and NPV is recommending project A. That's a conflicting decision, clearly. How do we solve this conflict? I come back to my favorite line here is, let's do apple to apple comparison. First of all, comparing project A to project B is not at all viable, because project A is of 6 years, project B is of 3 years. Also, capital investment is very different, right? We are talking about a 40 lakhs of investment in project A. Project B requires a 20 lakhs. So what we are doing here is we are saying that, okay, let's assume that you have another opportunity of project B after the project B is completed. So look at this now. We are repeating the project B at the end of the third year or at the beginning of the fourth year. So you can see the 2000 here. You can see the 700, 1300, and 1200. And then to follow it with at the end of the third year, again you invest 2000 and you have a 700, 1300, and 1200. So project B is done two times now. Project B is done two times. And now I'm getting the same IRR. I'm getting the same IRR here. Whereas my NPV is 882. But what has happened in this process is if I compare project A and the project B repeated twice, so we are comparing project A and we are comparing B2, the answer is unanimous. Both NPV and IRR are supporting project B now, but only if it is repeated twice. So it's the conflict is over now. Conflict is resolved. They are not fighting anymore. They're saying that, okay, we both favor project B repeated twice. Earlier there was a conflict, but now both are giving the common result. Everyone here, okay, guys? Can you please confirm if the replacement chain method is clear to everyone where the projects could be repeated? Please confirm on the query panel. Any questions, please let me know. Perfect. Thanks, guys. Thanks, Kadambri, Gajendra, Bandi. Superb. Okay. Now we move on to the second method, guys. We were talking about another method called equivalent annualized criteria at the bottom of the previous slide. What is this? I think name tells me something, right? We are saying we are equating something for sure here. Equivalent annualized criteria. We are absolutely at the last point on this slide here. This involves dividing the NPV of the project with unequal lives by their respective present value annuity factor. Okay, Shweta had a question and Srinivasan also had a question. Before I proceed to the next one, let me read their questions. Shweta says, can you please explain how we get 882? Shweta, we are talking about calculation of NPV at 12%. Na? 12% with the initial outflow of 2,700, 1,300. In the third year, net you have a negative 800, right? In the third year, make sure that you be careful because 1,200 is inflow and 2,000 is at the end of the year is another outflow, right? So make sure you kind of calculate the NPV using 12%. So NPV for all these cash flows from 0 to 6 is 882. Simple method now. I'm not kind of showing you the calculation, but you know what to do, right? Into 1.1 by 1.112 square and so on. You just calculate the present value of all these inflows and then you will get the NPV. You can check. Because of rounding off, your number is slightly variating. That's okay. Uh, Srinivasan had a question. What will happen if we further invest in A? Uh, Srinivasan, obviously, let's say if there are two possibilities now. Let's say the project B was not repeatable, or it was not in the same multiplication, or you had other strategic reasons to go with project A. Because if you're going with this assumption, project B is definitely beneficial, but there could be a possibility where the projects could not be divisible. Let's take this assumption, guys. Let's say my project A is of 6 years, but project B is of 4 years, and not we are not going into the LCM route. Multiply A by 2 and B by 3. We are not doing this. In that case, Srinivasan, replacement chain method is not suggested. In that case, we have equivalent analyzed criteria where the projects are not divisible. Where the projects are not divisible in terms of the life, we go with the equivalent analyzed criteria which we are yet to discuss now. All okay? So what does we do here? What do we do here? If the projects having unequal lives, If they are not repeatable, then what we'll do is we will divide the NPV by the present value annuity factor, whatever we have used to calculate the NPV. And whatever the highest value for a particular project is, we will select that project. So let's try that here. Let's assume, let's assume in this example, what if the projects could be repeated? If their lives were not in multiple, or for some reason, project B couldn't be repeated. I'm telling you, the project B cannot be repeated. It's just once in lifetime opportunity. So that case, what will you do is you will use the equivalent annualized criteria. So you are talking about the NPV 649K. Project B has 515, and I'm putting your present value annuity factor 12% for project A. This is for 6 years, and project B this is for 3 years. That's why the present value annuity factors are different, right? 4.112 for project A and 3 years for project B. So it's 2.40 And if I divide the NPV by this present value factors, so we're saying NPV divided by present value annuity factor. We are again selecting project B here. Project B is kind of being preferred here. Manish, that's the same answer I'm giving you. If the life was different, now you use this. But we are saying 6 years, 3 months, then you have to do a compounding impact. I'm not going there. I think don't worry about the examination will not calculate, make your calculation so complex. We're talking about compounding or discounting quarterly. It will be a further longer process. But even if it is there for a particular quarter, you can divide if you have to, if it was to discount it quarterly, you guys know what are the rules, right? I'm sure you guys know. Your rate will be divided by 4 and your N, the time period, will multiply by 4 if it was a quarterly situation. Okay, guys, everyone clear now with the equivalent criteria, equivalent analyzed criteria? Kanishka, which calculation you are talking about? Can you please tell me how to calculate NPV? You mean? Maybe we can pick one of the questions in where we can calculate the NPV and show you, right? Just let me know if you want to help in kind of calculating the NPV here. I will be doing a lot of practice on the other side of the session today, where you guys will be seeing the calculations of NPV. Don't worry. These are assuming that, okay, if you know, okay, how to discount the cash flows and add the present value of cash flows, like we did in the yesterday, right? I think yesterday we did a question on MTR already, right? This is just to save time. We are saying that, okay, if the NPV is calculated by you, we're just dividing this by present value annuity factor. Okay. Just in any ways, by any chance, if you guys are not 100% sure, let's say if an abstract of an annuity table is given to you, what do you do then? How do you, Tanishka, with reference to your question, I'm showing something to you guys. Let's say if you have an abstract of the annuity table, let me show you something. Okay, in this case, what is the rate given to us? 4.11 to 2.402, right? 2.402. So I'm just kind of quickly taking you to an annuity table with me. 12% annuity table, right? So I hope everyone can see annuity table right now on my screen. So just that everyone knows, yesterday also someone asked me this question, so kind of touching base. So if you're looking at 12%, so 12% goes on, and we're talking about annuity table, right? So present value, so we are looking at a cumulative present value for 12%. This, but 12% seems to be on the next page. Yeah, this is the relevant page for us. Cumulative present value factors, we are looking at 12%. We are looking at 6 years and 3 years. So for 6 years, we are having 4.111. For 3 years, we are having 2.402. These are the values we have taken over there. These are the values we have taken over there. And 99.99% you will have these factors or abstract given to you. In case you do not have, it's a simple calculator. You can always do that using a simple calculator. Like, let's say if I press 1 divided by 1.12 and I press equal to, I get 0.892. I can press M plus. There is an M plus option of your simple basic calculators. And then you can press equal to one more time, again M plus, one more time, again M plus. You can do this for how many years you require. So for example, if I do this for 3 years, and when I press that grand total or a button called MRC, I'm getting 2.4018. That is 2.402. So basically, present value annuity factor is nothing but basically this. So for 3 years, you can have this. That's your answer. So, so Tanishka and everyone else, I'm just kind of sharing this so that you guys are having that comfort level that okay, how do we know the present value factors? They will be given to you. In case not, you don't need to worry about that simple calculator thing. And also in terms of once you have the cash flows, remember the entire session yesterday was based on calculating the cash flows, right? You have to talk about the non-cash expenses, tax shield, you have to ignore the interest cost. So if you have the relevant cash inflows, you have to just multiply these present factors, that's it. So if you have a annuity, if you're talking about annuity, that means same cash flows every year, you will multiply with this present value annuity factor. But if you have a different cash flows every year, then you will have cash flow year 1 into 1 upon 1 plus r plus cash flow year 2 multiplied by 1 upon 1 plus r square. So again, this is how the entire calculation will flow, right? So do not worry, guys. We have a lot of questions coming up your side, and we will do some calculations also there. I will ask your basically inputs on the calculation note as well. Okay. So let's do one thing. Okay. Let me pick up a question for you guys before we go for the break, so that you guys have a little bit of comfort factor here. Just give me a second. Okay. So there is one more typical type of questions which comes up, with respect to replacement of machinery, but we will talk about that maybe after the break. But I'm picking another question right now. In the meantime, Manish has a point. In the case of MIRR, when there is a second outflow and you net off it with the inflow for that year, that comes out to be negative. Should I discount it to initial outflow or compound it? No, you have to compounding it, na? So Manish, compound it. It compounded. Please do not net off. Compound it as a negative number. That's okay. That's the logic of MIRR. Compound it as a negative number. If there is an outflow in between, you are compounding it, it will be a negative number, right? Okay. So guys, before we kind of move on the break note, I would like to quickly talk about one question before the break. And then after the break, we have a lot of practice questions coming your way, guys. A lot of practice questions. Specifically, we'll start with something called a replacement of machinery. This is a very, very good question we have. But before we go there, a question for unlocking the next video game zone, I guess, right? So you have a lot of stages in the video games. I'm sure all of you play the games and you have to unlock the next stage. So first you have to clear the first round. So Unlock Limited wants to replace its old machine with a new automatic machine. Two models, A and B, are available at the same cost of 5 lakhs each. I hope everyone can see the question. Salvage value of the old machine is 1 lakh. The utilities of the existing machine can be used. This is an important point, guys. So the outflow is 5 lakhs each. Salvage value of only old machine is given 1 lakh. Utilities of the existing machine can be used if company purchases A. Additional cost of utilities to be purchased in that case is 1 lakh. But if the company goes for a machine B, then you cannot use the existing utilities and you have to go for the new entirely 100% new utilities of 2 lakhs. And the salvage value of the old utilities in that case would be 0.2 lakhs here. And they're giving you the cash inflows for years 1 to 5 here for both the machineries, and they're giving the salvage value of the machines as well. And present value factors, like I said, is given. Target return on capital is 15%. On that basis, your present value factors are given. What we have to do is we have to calculate the NPV, discounted payback, desirability factor for each of the machines. So kind of a quick practice for everyone before we kind of wrap up the first half of the session. So what do we do, guys? In this case, we need to consider what are the outflows or what are the relevant cash flows for each of the options, right? So you have to understand what are the relevant cash flows. So for example, can I say initial investment is 5 lakhs for both? At time zero, can I say 5 lakhs for both? Do you all agree with me on that note? What do you think, guys? I hope everyone agrees with me. Or is there anything else going in for a different machine? Initial investment is 5 lakhs for both, but is there something to do with the utilities, guys? So if I talk about project A, what is the initial investment? Yes, no, no, that's what I'm asking. Project A, so initial investment for both the machine is 5 lakhs. But if I consider the old machinery and utilities, so 5 lakhs is my initial investment. Old machine sale value is 1 lakh, and then there is a additional utilities of 1 lakhs here. So that means for machine A, we are looking at 5 lakhs as an initial outflow. For for a machine B, we have again cost of 5 lakhs minus sale of the old machine 1 lakh plus 2 lakhs here utilities minus 20,000 because the existing utilities salvage value would be there. So I'm getting 5 lakh 80,000. So this is the only important step in this particular question you need to understand. The machinery A and B, what will be the cash outflow for initial investment? Net 5 lakhs for machine A and net like 5 lakh 80,000 for machine B. Why? I'm repeating again. 5 lakhs is the cost of the machine. 1 lakh is the salvage of the old machine. So in 5 minus 1, 4 is common for both the machines. 4 lakh is common. This section of 4 lakhs is common for both the machines, guys. But then in the case of machine A, the existing utilities can be used and you need only additional 1 lakh. So that makes it 5 again. In the case of machine B, you have to go for entire new utilities, but you're having a 20,000 of scrap from the existing utilities. So I want a confirmation for everyone. Is 5 lakhs and 5 lakh 80,000 clear to all of you? 5 lakhs and 5 lakh 80,000 to clear for this particular point. Yes, Sweta, we have just considered that. What about others? I think the most important point in this particular question is this step. Rest is history. Rest is given to you. It's the calculation we will see now. Okay. So now let's see our calculations now, guys. So I think the everyone is pretty much rock solid on the first 2 points. Everything else is given to us. 1 lakh, 150, 180, 2 lakhs, and in the last year we are talking about a 220. Okay. So fifth year also is important, right? Fifth year is also important because in the fifth year you have the salvage value added here. So 220 for machine A and 1 lakh for machine B. The fifth year. So you can see the 220 for machine A and 1 lakh for machine B. So we are getting the cash flows for all the, or like rather both the machines here. And then based on the discounting factors, we are calculating the present value for machine A scenario, and we are saying the present value of machine B scenario. So the machine A, by calculating the present value basically, is giving me a total NPV of 43,800. Whereas machine B is giving me 19,300 here. So if I were to select based on NPV, I would go with machine A. Now, it was also called asking for the cumulative, rather discounted payback period, right? Discounted payback period. Now, for discounted payback period, what do you need is for the discounted payback period, you need a cumulative inflows because this is uneven. This is uneven cash flow, so you need a cumulative discounted cash flow. So you have 87 for the first year. Next year is 87 plus 114, you get 201. 114 plus 118, you get 319, and so on. And if I calculate the discounted payback method here, discounted payback for machine A, where the 5 lakhs was investment, I can say 4 years definitely. Was till the fourth year, I'm getting 433,800. How much is the amount that I need to, you know, get additionally? 5 lakhs minus 433,800. So I'm getting 66,200 here, divided by my cash flows in the fifth year, which is 1,10,000. So that divided by 1,10,000. So 66,200 divided by 1,10,000 is 0 point or other 4.6. 4 plus 0.6. I'm getting 4.6 years. I hope the discounted payback calculation is clear. Similarly for B, similarly for B, we are saying that we invested 5,80,000. That is absolutely coming in after fourth year. That is also for B also it is 4 plus, but we are left with 5,80,000 minus 549,300. How much is the cumulative investment till fourth, cumulative inflows till fourth year? 549,300. How much more to go? We we need 30,700 to make it 5,80,000. So that means 30,700. And in the fifth year, I guess you guys have a 50,000. So 30,700 divided by 50,000, I'm getting 0.61. So can you see what a close call here? 4.60 versus 4.61. So slightly, very much close call between project A and B, but yes, slightly project A is ahead, even for the discounted payback. Profitability index, obviously, it's a very, very simple thing. You have to just kind of, divide your, present value of inflows divided by present, initial investment, and you're getting 1.09 and 1.03. How do I get that? You can, for project A, you can do a 543,800 divided by 5 lakhs. For project B, you can do a 599,300 divided by 5,80,000. So all the three methods are favoring machine E here. But I think the most important point in this particular question was to understand the outflows of the both the machines. That was the most important point. Other than that, I think it's a very, very straightforward question, I guess. But I hope everyone is clear in terms of calculating the present value. Just have to multiply. You just have to multiply the present value factor with the cash flow. So for example, 1 lakh into 0.87 is 87,000. Another example, point 57 into 2 lakhs is 1 lakh 14,000. So you just have to multiply the present value factors with the cash flows, and you get the present value, and you have to add them up to get the NPV. I hope this example is clear to everyone. Paniksha, Kiran, Srinivas, all okay, guys? If all is okay, we will probably take a break here because it's like 7:24 now. So let's take a quick break of 10 minutes. Once we come back, guys, we will resume our discussion from our practice perspective, but we will be talking about one of the special cases which talks about the replacement of existing machinery. There are some way to take about this. We have a question or two. We'll do one question here and one question is for your practice. So we have a couple of questions on this. A very, very interesting, comprehensive question, I would say. And we will have more questions, of course, after this. So as I said, guys, the PDF which I have uploaded has more than, let's say, 10 or 12 questions. But let's say even if we do a 50-60% questions in the sessions, do the remaining questions as your practice, guys. The rest of the questions which are there as your homework. Okay. So let's meet in another 10 minutes with the same energy levels, guys. Let's take a quick break. Okay, guys, welcome back. I hope everyone is back from the much needed break. And would like to definitely say that, you should tighten your seat belts now because the next 1 hour we are absolutely going through a very, very interesting weather. So there would be turbulence. There will be a lot of practice coming your way. So I want the same participation, same excitement, same energy levels. So we continue our discussion on practice notes. So we are talking about some special case with respect to capital budgeting, which involves a situation where you have a decision with respect to replacement of existing machinery. So we're talking about, the question in front of us is whether an existing asset should be replaced by a newer version of the same machine or even a different type of machine. I hope everyone agree here that over the time period with the advent of technology, you may not have the same asset doing the same function, or even if it is doing the same function, you may need to update, right? You may need to update. I remember the days where I'm talking about like early 1990s, where before the printers and everything, there used to be typewriters. I don't know how many of you have heard about typewriter. You used to type, the person on the typewriter used to type, and then kind of slide back the toner towards the left and then again type. It used to be a typewriter fashion, right? Then we talk about the computers and the printers and everything came in before even computers were there. I remember the day. I don't know if anyone has seen that video somewhere. You may find it. It was a very, very funny thing that what happened, like suddenly when the machinery got changed, upgraded. The person who was used to work on the typewriter, on one day he was given a desktop. Imagine a person who has been using the typewriter for almost like last 10-15 years. Suddenly a desktop is given to that person. So what that person did actually, she was typing on the keyboard, and just by the usual habit, she suddenly slide the monitor towards the left and the monitor went down, right? So we are not talking about that kind of a machinery replacement here, but we are trying to say is that we need to upgrade ourselves in terms of the technology requirements. And that's why the bigger companies would always be posed this with problem with the additional requirements of the customers or additional features the new machineries could have. Take a simple example of a printer also, right? When the printers came into the picture, it was only printers, right? Then they came with the printers and the scanners, and now you have like printer, scanner, fax, almost like multifunctional devices. So you may have a different type of machine here, or a new machine altogether. Now, what factors do you need to consider, right? Obviously, I think any decision that needs to be taken is would always be considering that whether you are gaining out of that decision or not, right? So we are talking about, let's say, in terms of the investment, for whether your returns, your benefits are more than cost or not, right? Whether the benefits is more than the cost or not. So the factors that need to be considered here is obviously the cost of new machines, sale value or exchange value of the existing machine, operating cash flows generated by existing and new machine. So salvage value of the new machine, tax impact of the sale of existing machine, with or without block of assets. Remember the block of assets I told you yesterday? That means we are considering only on relevant or incremental cash flows. We are kind of evaluating the criteria because, see, the point here is we're saying operating cash flows generated by existing and new. So you may want to consider that, okay, what is the differential, right? So there are few steps, which these are suggested steps, guys, and you guys can apply these steps with flexibility as and when, as you are comfortable, as you are understanding the concept. So we may want to consider what is my net cash out, step one, like more of a in consideration with initial investment, right? So assume that at today's value, so we are saying, okay, book value of the old equipment, minus the market value of the old equipment into tax rate would be the tax payable or savings, depending on, like, so the first point is like tax on gain or loss. If it's a loss, it could be a tax saving. If it's a gain, it would be a tax payable. And then, of course, it's a cost of new equipment. And of course, here we are considering that if it's a last asset in the block, because if there are other assets in the block, you may not be, or you would not be requiring to calculate any gain or loss, right? Because if there are other assets and you're using the block of asset concept. Cost of new equipment, of course, we're talking about in this case is the market value of the, you know, whatever the equipment you have purchased here, minus the tax payable or savings. plus the market value of the old equipment. That's your B point is after get adjusting the calculation of A point. So basically what we're trying to say is, let's say I have invested 10 lakhs here and I am selling the old asset for 50,000. But the old asset's value, it was the last asset in the block. The old asset value was 30,000. So the tax on that is like 50 minus 30 into, let's say, a 30%. So that means we are talking about a 6,000 here. So that means 10 lakhs minus 50,000. So 9 lakh 44,000 would be my initial investment. So 10 lakh minus 50,000 minus 6,000, right? So net cash outflow is what we need to calculate. Now estimate the change in cash flow per year. This is what I'm trying to say here, right? We are talking about the incremental, what is changing, because existing machine is also doing something, right? You're already generating revenue based on the existing machine. You're just upgrading the machine now. So what is the change in the cash flow if the replacement decision is implemented? So you may have to consider, okay, what is the change in sales? What is the change in cost? Change in depreciation? Everything is, change, replacement, right? We're talking about like incremental, relevant. So we're talking about change in the cash flow. And then step three is the present value. Present value of the yearly cash flows, present value of the estimated salvage of the new machine at the end of the project. And then the net present value will be the difference between the two. So of course, if your benefits is more than the cost, you are happy here. You can replace it, else you can reject it, guys. I think pretty much basic steps as you already do for a capital budgeting NPV method. It's just that here the focus is on change. What has changed, right? We're talking about only what has changed, right? So here we will talk about a very important a question here, which will be kind of pretty much interesting for everyone though. And following that, it with is another question which will be for your practice or your homework, right? So let's kind of focus our divert our focus on the first question here for the replacement of machinery. That is Zavli Limited has a machine which has been in operation for 3 years with, and the machine has remaining estimated useful life of 5 years here with no salvage value in the year in the end. Its current market value is 2 lakhs here, right? So we have already been operating this for 3 years and estimated useful life was 5 years. So that means it could probably go in for 2 more years. Company is considering a proposal to purchase a new model of machine to replace the existing machine, and they're giving you the relevant information. I think this word always catches my eyes, right? Relevant information. We are anyways talking about relevant and incremental here. So look at this cost of existing machine, new machine. I don't know. I think you guys are all matured enough to identify if there is any sunk cost. So probably existing machine cost would be the sunk cost that I would have incurred 3 years before. But yes, I'm very much interested in some of the relevant cost here. So let's kind of have a small tick mark against them. So 10 lakhs could be relevant for us, right? So we are talking about a new machine in this case. Now, in that case, we are looking at estimated life 5 years for the new machine. Mind you, the existing machine also had a remaining estimated life of 5 years. So 5 plus 3 is 8. So that's what they mentioned here. Salvage value is 40,000 here. I think market value of the existing machine is already given to us as 2 lakhs. Annual output is, I can already see a reason for which the company is thinking of changing the machine or replacing the machine, because I can see a significant change in the volume of the sales, right? 30,000 to 75,000. Selling price per unit of 15. Annual operating hours. Material cost is same, but labor costs have increased though. Probably because of the advanced machine, you might need advanced or a skilled labor. That's okay. And indirect cash cost is also increasing. So you have additional benefits, but additional cost also. And the company uses return on value of depreciation at 20%. And look at this one, guys. It has several other machines in the block of assets. This is important for us. Block of assets. That means we may not consider the gain or loss, but we may also consider the depreciation, how the depreciation will be calculated. Income tax is 30%, and Zavli does not make any investment if it yields less than 12%. So that means if they've given you that you do not make any investment less than 12%, that's your hurdle rate. That means that's your discounting rate. And they're giving you the present value factors here for all the 5 years, right? Everyone ready for some kind of a interesting discussion here, guys? That means if I were to consider initially, and we'll go step by step here. We'll go step by step. if I were to consider the what is the initial cash outflow, guys? What do you think? What is the initial cash outflow for us? Anyone? Initial cash outflow. Let's see your answers. I think 10 lakhs is the cost of the machine. So who will tell me the initial cash outflow here? Okay, so Gajendra says cost of machine less salvage. So Gajendra is trying to say is that okay, in this case, the cost of the machine is 10 lakhs, but we are also talking about the salvage of the old machine, which is 2 lakhs given to us in the top paragraph. So can I say 8 lakhs is my existing or the initial cash outflow, guys? 8 lakhs. And would I say that Gajendra says 960? Why 960? I think you have taken 40,000 incorrectly. 40,000 is the salary of the new machine, Gajendra. You have to take 2 lakhs, na? The 2 lakhs mentioned in the question at the top, right, Ninad? Absolutely, 8 lakhs. So what I'm saying to say is if the initial investment is 8 lakh, I would go with the replacement only if the present value of the increased or incremental, if the present value of incremental cash flow is more than 8 lakhs. That's what my agenda here is to calculate the overall scenario. Manish, no 760. Why you are reduced, guys? I think you guys are confused with 40,000. 40,000 is not relevant right now. 40,000 is not relevant right now. 40,000 may be relevant for the fifth year though. 40,000 will be relevant for the fifth year. Initial investment will not be relevant. We will consider 40,000, but the end of the like the terminal year cash flows. Everyone okay, guys? But that means we have to. The next step is so we know the initial investment is 8 lakhs. The next step is to calculate the incremental cash inflows, guys. Can I say that? The next step is to calculate incremental. We have to do that, this exercise. I hope everyone was with me on this. So we have to calculate the incremental, and then maybe what we'll do is we will also go ahead with the calculation of the present value factors along with that. I hope all are doing good, guys. What do you think? Now, one more thing I want to talk about here is, guys, if I were to consider the calculation part of the initial, or rather, I would say that if we were to consider the overall calculation in terms of the incremental cash flows, what all do we need? We have to consider what all do we need here. We have to calculate the incremental sales, right? So we have a 30,000 existing machine and 75,000 for the new machine. So sales is 15. So basically, what we need to understand here is what we need to understand here is in this scenario, my additional units is 45,000. So I'm getting a 45,000 into 15, which is 6,75,000 every year, right? Am I correct? But that is additional revenue. What happens with respect to the what happens with respect to the labor cost, guys? What happens to the labor cost? I think the material cost is also changing. Labor cost is also changing. We have to see how many hours do we need to kind of. So 675 is my additional sales. Additional material will be 45,000 into 4 is 180. And the operating hours is same 3,000. But the additional cost is 4270. So 3,000 into 30, right? 3,000 into 30 is how much? 90,000. So everyone with me on this? 675 is additional sales. Additional material cost is 180. and we are talking about 90,000 of additional labor costs as well. What do you think? Additional 90,000. We also have a straightforward incremental cost in terms of indirect cash cost of 15,000 here. So the biggest question here is with in front of us is what is the incremental depreciation, guys? So we have to kind of calculate the tax shield on change in depreciation. So we have to calculate the change in depreciation tax shield. So what will be the change in depreciation, right? So I think let's try to understand that part. Okay. So let's try to do that. Give me a quick second. Yes. So here we are looking at our overall computation in terms of the initial cost we discussed of 8 lakhs here. Now, if we are looking at uh, incremental depreciation, what we need to consider is what is the WDV of the existing machine. So cost of the existing machine is 3,30,000. That's very, very important for us. That's given to us. And mind you, the depreciation is written down value. So that's what can make it complicated. This is written down value method, guys. So 3,30,000, it is already used for 3 years. So we are calculating the depreciation for the first year, second year, and hence we need to calculate the WDV. We need to calculate WDV at the beginning of the fourth year. That is today. That happens to be 1,68,960. So 330, I guess we are getting a 20%, 266, which will be 264,000 into 20%, which will give you 52,800 and so on. Everyone knows how to calculate the WDV depreciation. Now, since we are talking about a block of assets, guys, very, very important that we understand that you are talking about a WDV of the existing machine is 1,68,000. Cost of machine is 10 lakhs. Are we calculating any gain or loss here? No, we are not calculating any gain or loss. We're saying that my total block becomes 11,68,960. And since we are selling this for 2 lakhs, the remaining value is 9,68,960. So that means we are back to the stage one. We are back to the square one. So we are talking about the current WDV is 168,960. Current WDV of block, I would say. And let's say if you're talking about like the the base for the new WDV block, we are talking about 968, 960. Very logically, this is not surprise. The incremental base is 8 lakhs. That's what the initial outflow was. It had to be, but we have to do a cross check. We have to double check. It has to be 8 lakhs. It has to be 8 lakhs. So that means we are ready with some of the factors already. We are ready with some of the factors already. We know what is my incremental revenue. We know what is my incremental cost in terms of material, labor, and indirect costs. And we know what will be the base for the depreciation. So now is the time to compile everything, guys. So we can compile everything here on the right hand side. So we had additional sales revenue of 675. That's what we discussed. We had additional material 180, additional labor of 90, and 15,000 of indirect costs. So all of these add up to how much? 180 plus 90 plus 15 is 285. All these three. So 675 minus 285 is 3,90,000. Mind you, this is profit before tax and depreciation, because now depreciation will be calculated on this. So we will have to consider the WDV depreciation for tax shield for 5 years. But I need a quick confirmation from everyone. Whatever we have done so far, is it okay? Is it clear to everyone? Are you guys understanding what we are doing? We are moving to an incremental approach here. We are discussing an incremental approach for everyone's benefit. Can you guys please confirm in the query panel any doubts till now on this question? Let me know, guys. Any doubts till now? Very nice. Kadambri, thanks, Sahil. Gajendra, thanks a lot. Confirmation. Okay. So now let's kind of compile this with respect to the information we have. So we are talking about a profit before tax and depreciation for every year coming from the last slide is 3,90,000. And we know what is the depreciation to be charged on 8 lakh initially. 8 lakh initially. So first year depreciation is 1,60,000. So that means it will reduce my profit before tax to 230. And on 230, we are calculating the tax. And then, mind you, what we are discussing here is net cash flow is calculated by adding back the depreciation. Remember, we discussed method one yesterday, where you are adding back the depreciation. So what we are doing is, how do we arrive at 321? For example, we're saying 230 minus 69 plus 160. 230 minus 69 plus 160. 160 is depreciation which is added back, which is giving me 321,000. Similarly, for the next year, depreciation gets changed. Depreciation of the next year is 6,40,000 into 20%. So which is giving me 128. So that's how you have to do this exercise every year, guys. So your net cash flow will change for every year accordingly. Why? Because the depreciation was WDV. So we have to thanks Shweta. Yeah, I think you can do that. That's not a bad idea. If in case you want to read kind of listen a bit of theory or a bit of concept, that's always a good idea. But my point is, guys, everyone understood here that why we are doing this, why we have to do this table, because the depreciation is WDV. If it was a straight line method, we would have a simple annuity with us. But since every year's depreciation is based on a return on value, your depreciation gets reduced and reduced. And hence your cash flows get reduced and reduced because you are having a lesser and lesser tax savings every year on depreciation because your depreciation is reducing here. So we are calculating the present value of the cash flows for every year and adding them up gives me 11,06,285. Now someone was talking about 40,000 initially. As I said, 40,000 the salvage value of the new machine, which will be considered at the end of fifth year. That will be added as a terminal year cash inflow. 40,000 present value is 22,680. So that is what is considered here. And then we reduce the initial outflow and we are getting a big positive NPV, guys. Big positive means existing machinery should be replaced. We're getting a big positive NPV of 3,28,000. Everyone okay here? I think it's a very good question. The only thing is, yes, I would not say complicated, but yeah, you have to be very careful in terms of the steps. That at every step you need to consider that you are taking incremental impact. Otherwise, I know historically students have asked me that, sir, can we do this? Can we take this scenario where we have a existing situation and then a new situation and then compare between the two? Yeah, why you want to do the entire calculation two times, right? It's incremental, you are saving time. Question from Preetham, sir, why we have not taken depreciation of 968, 960? Okay, Preetham, I think when you wrote that question, exactly at that point I was explaining something. And that point is you need to consider this. We are talking about incremental, right? Preetham, I have a question for you. What is the existing WDV 168, 960? What will be the base for the new machine 968, 960? We are calculating everything on incremental perspective. So 968, 960 minus 168, 960. So we're calculating on the differential, right? Everything is done incrementally. If I take 968, then I have to do this exercise two times. What is happening currently and what will happen if I change it. And then I take the difference. So I think then you will have to spend double the time here. So if I don't do incremental approach, what I will have to do is, what is the existing scenario? What are the existing cash flows? What is the present value of the existing cash flows? What is the NPV of the existing machine? Then I will do, okay, what if I replace it? Scenario two, what is the new cash flows? What is the NPV of the new cash flows? And then the difference. So you don't do to do the scenario two times, right? idea is this will save your time. You have to understand the incremental approach though. And I think I would like to thank you for asking that question actually, because I think a lot of students may be wondering, may have that same doubt. Pritam, most welcome. I think everyone is thanking you actually, because some of other students were also thinking on that note, and you had clarified this for them as well. Very nice. Everyone clear now, guys? I think it's a very good question, but yes, of course, need some practice and a special scenario of replacement of machinery. And as I promised, guys, you guys have a quick, a question here. Not I'm not solving this here, but you guys can do it later on in terms of as your homework. Another question with respect to the replacement of machinery here. So the question which starts with HMR limited. This is your homework, guys, for this particular topic, right? Now, before I go to the next bigger question, let's see how you guys are doing in terms of your concepts. Let's have a quick couple of MCQs. So here we go with couple of MCQs here, wherein you are to mention question number one with your or question number two with your answers, guys. Let's see. You have to mention question number one or question number two with your answers. One question relates to yesterday's discussion, one question for today's discussion. Manish is on the top of his game. He's giving me both the answers, Biswajit as well. But the point is, how many of you got the correct answer? We can discuss question number one in the meantime, because I think majority is giving me correct answer, option number A. See, the question is release of working capital at the end of the project. The point is release. That means initially there would have been an additional working capital, would have been an outflow, and in the terminal year, at the end of the project, it will be an inflow. So I agree with you guys. This happens to be a cash inflow, guys. Very nice. Okay, what about question number two, guys? Till now, question number two, may I'm getting two different answers. So let's see. I'm waiting for others also for question number two. This was a shortcoming we discussed for IRR when we started the session today. Okay, so I'm getting question number two. Uh, some people are giving me answer as B, some people are giving me answer as C here. So we're saying multiple IRRs. As we discussed, like when specifically the case where the IRR, but what if there are outflows later also? And when I say outflows later, that means we're talking about the cash flows reverse their signs during the project. Like initially you have a minus, later on you have a plus, 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 plus. But let's say out of suddenly you have a minus at the end of year three. So that's where the multiple IRRs are there, and that's why we discussed right a couple of approaches for that. Specifically with respect to a modified IRR. Right? We talk about the modified IRR. Hence, answer is actually option number B and not C, guys, because the question is multiple IRRs. So you may need more than one IRR if you are not doing a modified IRR. So solution is a modified IRR where we discussed calculating the compounded values of the cash flow toward the end except the initial value. It's the initial investment. So that's option number B. I think some of you correctly remembered. That's very nice. Superb. I think now is the time for our second question of the second practice question of the initial series. So let's go here. Let's talk about this together. I think this is a very, very good question. One of my favorite questions. Let's see how you want to tackle it. The question on the screen is with respect to not Bajrangi Bhaijan, but this is with respect to a Bajrangi Chimney Company. So let's see what they are doing. So Chimney Company is evaluating three investment situations here: producing a new line of aluminum chimneys, expanding its line to include several new variants, developing a new higher quality line of exhaust. Wow. So if only one project is undertaken, so I think in this question, guys, you have to be very, very careful and attentive, guys. The question itself has a lot of important information for us. So if only one project is undertaken, then its standalone expected present value and amount of investment is here below for all the three projects. Investment and present value is given to us. I think first thing I can do is I can quickly calculate the NPV here. I can calculate NPV. NPV of the first project is 90,000 here. Second is 70. And third one is 1,30,000. So one thing is we know is here with us is our overall NPV in terms of when if you're only selecting one project is 90, 70 and 1,30,000, which is very simple mathematical thing. But now we give a lot of other information for us, which is if projects 1 and 2 are jointly undertaken, there will be no savings. There will be no savings. Investments required and the present values will be simply a total here. So that means if I take about 1 and 2 together, guys, what is my initial investment? 315. And what is the present value of the cash inflows? 290 plus 185. What is that? 475, right? So if I take 1 and 2 together, I'm talking about 1,60,000. So that means if I understand the question, the last line of the question is advise which combination is best. I can immediately conclude that doing only one project is not fruitful. Why? Because if I do only project one, it is giving me 90,000 NPV. If I'm doing only project two, it is giving me 70,000. If I'm doing only project three, it's giving me NPV of 1,30,000. But when I combine the project one and two, my NPV becomes 1,60,000. That means one thing I'm outrightly rejecting is I will not do the projects independently, but I will combine the projects. As of now, project one and two combined NPV is better than individual NPVs. Very logical. So that is what I have concluded. But let's see other combination situations also. With projects 1 and 3, all eyes on 1 and 3 here. 1 and 3. Economies are possible in investment because one of the machines acquired can be used in both production processes. That's interesting. So total investment for 1 and 3 is 4,40,000 guys. If I see the information in the table, 2 lakhs and 270. So if I talk about 1 and 3 taken together, my initial investment comes to 470, but there is some saving here which says that okay, it becomes 440 actually. That means there is a saving, some economy here of 30,000. Some of the machine or the component may not be required, right? So they're saying 440. I saved 30,000 here. Instead of 4,70,000, they're saying 440. But they're not talking about anything about the cash flows. So let's talk about the cash flows also. So 1 and 3 cash flows total is 290 plus 4 lakhs, which gives me 690 here. Which gives me a 690 here, guys. So if I see 1 and 3, the combined NPV for both the projects 1 and 3 is 250. Amazing, right? Very amazingly high, 250. Everyone with me till this point, guys? Because if you guys are with me, you guys can also you guys can simply say that in terms of the combinations, I can easily reject option 1 and 2 also, because that was 160 and 1 and 3 is higher. 1 and 3 is higher than 1 and 2. Right now, 1 and 3 is leading the way. Can I say that? Yes or no? 1 and 3 seems to be good till now. We are yet to see the other parts of the question also. Sahil is asking a very different question. Sahil is asking skewness in cash flow. Sahil, skewness is like, you're talking about a typical variation, right? I would not say like erratic, right? Pretty much different patterns. Okay, everyone okay with this point, guys? Till now, one like project one and two, 1, 2, and 3 individually cannot be taken. Project 1 and 2 should not be taken. If something needs to be taken, is 1 and 3 till now. Now let's focus on other parts of the question here. Let's move ahead. In the other parts, we are talking about if projects 2 and 3 are undertaken, there are economies in marketing and producing products, but not in the investment. Wow. So if we say 2 and 3, investments, initial investment is same, 115 plus 270, 115 plus 270 is like 385. Expected present value of the cash flows shall be rupees 6,20,000. So how much I'm getting? Otherwise, 2 and 3 was giving me 585, but they're not talking about 585. Why? Because there is a some expenses are marketing, and some expenses are definitely reduced here. So instead of a 585, I'm saying my cash flows are 620 here. So that means my NPV, if I do 2 and 3 both together, it is 235. 235. That is a very, very handsome proposition, but unfortunately, combination 2 and 3 is also not beating the other combination of 1 and 3, guys. 2 and 3 is not beating the 1 and 3 combination, which we have already got 250 on the top. That means we are saying yes, we can probably outrightly reject 2 and 3 also. There is one more possibility left. We can discuss that now, but I need a quick confirmation on the query panel. If you guys are all okay till now, you guys are understanding the evaluations here. Everyone is able to understand the evaluation pattern. Okay, Manish says clear till now. Ninath says, Bhumika says, very nice. Now let's talk about if all the three projects, there is one more scenario, all the three projects taken simultaneously, the economies noted will still hold. Very nice. What are the economies we have noted? For 1 and 3, economies were in investment, and for 2 and 3, the economies are in the expenses. But look at this, guys. There is saying that if you have to do that, 1,25,000 extension on plant will be necessary because space is not available. Wow. So if I say 1, 2, and 3, what is my initial investment, guys? I think economy was there in 1 and 3. So 1 and 3 was 440. Project 2 is 115. And there is 125 additionally required. So I'm getting 680 as a total outflow. 680 as a total outflow. If all the three projects have to be taken, 680 is the total outflow. How 680? 1 and 3 mein there was a saving. We had taken 440 from the top left. 440. Second project 115 given in the table here, and 125 extra. So initial outflow is here in terms of understanding is 680, guys. And what are the present value of the cash flows? There was some saving in 2 and 3, right? So 2 and 3 ke liye we say 2 and 3 cash flows is 620 given to us. For one, we can take from the table is 290. It's giving me a 910. 910. So that means I'm getting a NPV of 230. Wow. That's a very, very close call. That's a close call from the combination which was leading till now. The combination of 1 and 3 was leading till now 235, or rather 250, right? 250, not even 235, 250. So this, so basically 2 and 3 is 235 gone. 1 and 2 and 3 is also 230, should be automatically rejected because it is even lesser than the 2 and 3. So that means upon evaluating a lot of combinations, what we are getting here is that this particular combination is the best. So you can see quickly here, what I've done is different combinations, and the economies are shaded in the green color and the blue color respectively, so that you guys can understand this. Investment required, you can see economies mentioned in the green color together. Similarly, the savings in the expenses is highlighted in the blue color. But the net present value, the last column, is the maximum for only 1 and 3, that is 2,50,000, guys. So it is pretty much more than other options we already discussed. So the clear suggestion is 1 and 3. I think when we talk about these type of evaluations, don't you think that we all like feel like a real finance manager role here? If you have to do these kind of evaluations, that's what is kind of a very much a significant contribution to justify your role as a finance manager. I hope everyone agrees with me on this. Any questions on this one, guys? Because if you know there are no questions, we are going with another question then. Any questions, guys, till now? All clear? Okay, very nice. Okay, now we talk about another one, guys, which is again in terms of a calculation heavy question, in terms of how do we calculate overall, impact. So there are a few questions which are calculation heavy in terms of, what you can do as a practice. So let me just quickly go through without solving some questions, but I'm just showing you. One question is with respect to ANR Limited, which is with respect to the machinery investment, and they've given you what all the sales expenses would be there, and you have to calculate the NPV of the project. So, okay, Bhumika has a question. Sorry, so I have to just quickly go back to the last slide. Bhumika had a question that can you please explain the last part again about choosing all the three? Bhumika, in all the three, na, they have mentioned in all the three projects, there was a line which says economies noted will hold, right? So economies noted will remain. So what change was only the additional investment. So that means, so if you see that 2 lakhs plus 270 was 470, but it was a 440 here. So we are taking 440, and we are taking 1.15 project 2, and we're taking 1.25 together. So that's what we are doing here. Similarly, there was economies noted in 2 and 3's cash flows, which is instead of 585, we are talking about 620. So we are taking 620, and the project one is 290. So 620 plus 290 is 910. So economies noted are holding here, like it's like kind of same economies what we have discussed, but there is an additional investment of 1,25,000. See, or there is a shortcut. You guys can, you could talk about, using the other projects NPV, but that could be confusing. So I think I would not advise you to go there. Evaluate each option, independently. Okay, I would like to just quickly walk through one question, guys. I'm not solving with you guys here, but this is a more of a calculation heavy question. The next one, which says the company has an initial investment of some amount, and like how much is like 2,000 lakhs. Even a working capital is needed here, and you have a salvage value of 474.61. Plant and machinery would depreciate at 25%, and all this information is given: selling price, variable cost, fixed it. So I think everyone can easily calculate the NPV of the project and discuss the viability. So this is something you guys can calculate later on. If the NPV is positive, you can go ahead with the project. So solution is there with you guys. Do not worry about that. So I think this is very, very basic stuff. What I'm interested in quickly telling you, there is a part two of this question, guys. There is a part two of this question. Now, part two of this question talks about, again, it is a calculation of NPV, but this NPV is a little bit basis on the sensitivity analysis. Sensitivity. Sensitivity means like NPV is susceptible to change. So we are talking about NPV will change, right? So what will happen? So what will happen if the selling price goes down by 10%? So your entire calculation will go for a toss, right? Selling price will change, right? And then we are talking about increase in the cost of plant machinery by 10%. So we have to calculate NPV three times in this question. And that's why I'm not solving it. I'm keeping you for practice. We have to first calculate NPV as is current situation. Then second time you have to increase or decrease the selling price. And the third time you have to again calculate. So this is like more of a independent questions. In the option number 2B, you will only increase the cost of plant and machinery and don't do anything else. In the option 2A, you're doing only increase in the decrease in the selling price and nothing else. For example, let me show you. So if you see in this question, what's happening here is I'm given a selling price, right? Selling price of 500 and a variable cost is 50%, guys. If that's the case, how much is the variable cost per unit? 250 per unit, right? 500 plus into 50%, it's 250 per unit. That's what we are doing, right? And accordingly, accordingly, what's happening is, my contribution is 500 minus 250 is 250, and then you have fixed overheads excluding depreciation. Excluding depreciation is 300 lakhs per annum. So you have to calculate all that as well. But my point here is, if we were to calculate, let me actually quickly show you this aspect. Give me a second. Okay. So guys, everyone with me on this till when I say that you're talking about a contribution of a 250, uh, 250 into 10 lakhs and then minus 300 lakhs. What is the amount we are getting, guys? Contribution, how much amount we are getting? Can anyone tell me in this particular question? My contribution per unit is 250. So what you do is 10 lakhs multiplied by 250. And then there is a 300 lakhs here. So that means 2500 lakhs minus 300 lakhs is the fixed cost excluding depreciation. I'm getting 2200 here. So everyone agreeing with me here? Like 2200 excluding depreciation. 2200. And a confirmation on this. And then the point here is this will be involving a lot of calculation because depreciation is given as a 25% on a WDV method. WDV method. So that means you have to do a lot of calculations here. So let me show you my calculations on a different screen. So if you see 2200 is what we have. 2200 is what we have here. We have already calculated 2200. And that means net of tax, there is a tax of 35%. So 2200 minus 35% is 1430. 1430. And since there is a different depreciation every year because it's a WDV, right? So the depreciation, once we are calculating depreciation of 25% on an investment of 25% on an investment of 2000 lakhs, your return on value becomes 1500, and hence we are talking about let me just connect this. So after the depreciation or WDV will change, next year's depreciation, next year depreciation, and so on. So you have to calculate separately all the 5 years of depreciation, and accordingly the depreciation tax shield can be added to this amount of 1430. Mind you, how did we calculate 1430? 2200 minus 65%. Sorry, 35%. 35% tax. So you're getting 1430. That is your, uh, you know, profit before depreciation, I would say, cash flows before depreciation. And then we get a total, you know, or rather I would say profit after tax before depreciation. And we have straight away added the depreciation tax shield. Now, you guys remember this is a method 2 actually. If you want to do method 1, I am okay with that. Then you have to do like, you have to subtract the depreciation, then tax, and so on. It will be, in fact, a longer. In fact, remember yesterday you guys were asking me, sir, when can we use the second method? This is a good way, right? Otherwise, you can do a longer method where you have a contribution of 2200. You can apply that also. You may have a 2200 contribution, then depreciation of 500, then tax, then add back the depreciation. It's up to you. So method 1, you will have a different calculation altogether. In the method 1, you will not start with 1430, you will start with 2200 only. Is everyone clear on this? The difference between method 1 and method 2, I intentionally showed you these calculations so that you guys are aware of this. So we are talking about a depreciation tax shield being added directly, and my total cash flows are multiplied with the present value factor, and I get like 3000 bucks of, or 3000 lakhs or whatever it is, of NPV, which is a positive NPV, and I'm getting acceptance for this particular project of machinery. Any questions on this calculation, guys? This calculation is based on the method 2, which we discussed yesterday. Preetham, this is something we have already discussed yesterday. Preetham is asking me a question. Sir, what about the interest on bank loan? Preetham, financing cost is something we will ignore, right? Because we are already discounting the cash flows. If I include the interest and discount, that will be double discounting. I've answered this question yesterday itself. Okay. Okay. So guys, now coming back, if you guys are okay with this calculation part of it, I want to quickly talk about the second part of the question, sensitivity analysis. So let's go to that. Let's say we are talking about a selling price decreased by 10%. As I said, this is actually not one question. These are three questions. Within the one question, we are talking about another couple of questions. Like, what will be the NPV if we decrease the selling price? So you're saying, what will be the NPV? We will decrease the NPV, will decrease the selling price by 10%. So what has happened is, my selling price has gone down to 450 here. But look at that. In sensitivity, I have not changed my variable cost. Some people have a question here that, sir, variable cost was 50% of selling price. That's okay. That was the original selling price. But when you're changing the selling price, we're not changing the variable cost. Variable cost is remaining 250 here. The remaining 250. And the calculation on your screens here is based on method 1. So don't worry. You guys have both the methods with you now. Method 1 and method 2. Whatever is comfortable to you. But now I'm sure most of you would agree with me that if I use the method 1, like, it's very simple, straightforward, but it's like more work. So contribution, less fixed cost, then we're talking about profit before depreciation, less depreciation, then less tax, and then add back the depreciation, and then talk about the working. Okay, one more important step here, guys. One more important step here is, I hope you remember this, that in terms of calculation, there was some working capital discussion, right? There was some working capital, right? Remember, in this question, we are having a 800 working capital in the initial year that is being released in the last year. So that is also an inflow of year 5. So working capital is also a very, very important point to be discussed. So you can see that from as soon as I decrease my selling price by 10%, NPV from 3000 lakhs has gone down to 1920 lakhs. Obviously, that's the sensitivity. So the NPV is sensitive to the selling price change. NPV is sensitive to the selling price change. if you're making a change to the project cost by 10%, if you're making the change to the project cost by 10%, then also a lot of changes will be required, right? The most important point is if you're changing the project cost and nothing else, my depreciation calculation will go for a toss. My depreciation calculation will go for a toss because depreciation have to be, again discussed here. How do we calculate the depreciation? Because we are saying the project cost is no longer 2000, but rather, we're talking about 1800 or something like that, or rather it is increased, right? So we are saying, okay, increase in project cost. So 2000 plus 10%, 2200. So my first year depreciation is 550, and the next year depreciation accordingly will change. But depreciation will go for a toss here, right? So although it was a one question, but we have kind of split up into three questions. You guys can practice it later on. Okay, guys, it's almost 8:30 now. So there are few questions I have intentionally kept here for your practice. But one of those questions I would like to intentionally talk about here. So after this slide, you will see three more questions. One is Shiv Limited. I'm just showing you guys on the screen. So this is for your practice, guys. Shiv Limited, and then it is a Mary Limited question. One question I would like to quickly talk about in 5 minutes, guys, is very interesting question here. Uh, this is the last question discussion for the day. So, and then there is a city clap limited towards the end, which you can practice later on. But anyways, here we are talking about a biochemical company. This question revolves around a biochemical company is presently paying an outside firm of rupee 1 per gallon to dispose of the waste. So that means it's a biochemical company and it's kind of having a lot of obligations with respect to the disposal. So they're giving 1 per gallon to dispose of the waste. And at a normal capacity, the waste is about 50,000 gallons per year. 50,000 gallons per year. So how much you are paying to the outside firm here? Can anyone tell me? How much you are paying to the outside firm currently? I think 50,000 into 1, 50,000, right? Now what they have done is they have done some research. So after spending 40,000 on research, the company discovered that waste could be sold for 10 per gallon if it was processed further. But additional processing would, however, require an investment of 6 lakhs in new equipment. Wow. So we are talking about a 6 lakhs in new equipment, which would have an estimated life of 10 years. Depreciation, thank God, is a straight line method. Except for the cost incurred in advertising of 20,000 per year, no change in the present selling and administrative expenses is expected if the new product is sold, and the details of additional processing costs are given. Variable is 6 per gallon, fixed excluding depreciation is 50,000 per year. And they're saying that there are no losses in processing. It is assumed that the total waste processed in a given year will be sold in the same year. And estimates are same. 50,000 gallons will be processed further and they will be sold each year. So now management is confused, Management is coming to you. You guys are future CAs, future chartered accountants. And you're confused at whether should we continue to pay the outsider for disposing the waste or should we process it further, right? Can we process it further? So we have to consider, right? Can we process it further? Processing further would require some investment, but it will result in some revenue, some additional cost. Cost of capital is given 15%. Tax is very high here, 50% tax given to you. And present value factor is given to you 5.019. Now how to go about this question, guys? First of all, you guys were pretty much correct that if you have to evaluate these alternatives, disposing the waste by outsourcing was having an outflow of 50,000. I think some of you said that, Preetham and everyone else. But if you were having that expense here, you were also having some tax savings. This was your expense. So expense would have resulted in a tax saving. So net outflow, net of tax saving is 25,000 here. 25,000. Guys, just give me 5 more minutes, guys. We are done in 5 minutes, please. Now, go assessing of what is happening then. We have a contribution from sale of waste, like 10 rupees was the selling price. Variable cost is 6 per unit. 50,000 gallons every year. So my sale or rather contribution is coming at 2 lakhs. This information is given in the question itself. Selling price is 10, right at the top, first paragraph, selling price is given, and then variable cost is given. So contribution is 2 lakhs. They've given a fixed cost and advertising cost, right? Fixed cost is 50,000, advertisement cost is 20,000. So we're getting a total cost of 70. Mind you, there was a research also of 40,000, please. After spending 40,000 of the research, but I would like to highlight here, this was after spending 40,000 on research means, is it relevant? For me, research is already done, irrespective of my decision. Research is already done, irrespective. And hence, we are calling it as a sunk cost. So that is not relevant for us. For this decision, the research is not relevant for us. This is not relevant for us. So they basically what we are trying to do here is 2 lakhs minus 70 is 1,30,000. Cash inflows before tax, and then tax outflow is 50% here. And using our method 2, I've calculated the tax shield on depreciation, guys. What is the depreciation per year? 6 lakhs divided by 10 is 60,000. 60,000 is my depreciation, on which tax shield is 30. So my total annual cash flows becomes 1,30,000 minus 65 plus 30,000, 95,000 here. So guys, now my point is to everyone here, and I'm sure you guys can quickly answer this. If I go for processing, do I need to pay outside firm? If I go for processing of the waste, do I need to pay the outside firm like I was paying to the outside outsourcing firm, guys? If this is the case, if I'm processing the waste, don't you think the current payment will be more of a saving now? More of a, not an opportunity cost, but an opportunity benefit, right? You're not going to pay the outsourcing firm now. Do you guys agree with me? Can I say from in this 95,000, there will be no need of making any payment to the outsourcing firm. Hence, my total cash inflows becomes 1,20,000 now. 95,000 plus 25, 120. Do you agree with this? And if that is the case, I can quickly calculate the present value of 1,20,000 into 5.019. 6 lakh 2,000. My initial outflow is 6 lakhs. I can see there is a positive NPV. That means obviously you can go ahead with the processing. Who knows that tomorrow you may earn more revenue here. So this is basically a different question here. We are evaluating a couple of alternatives. Just that instead of opportunity cost, we are taking a savings of that cost because you're not going to pay the outside firm that extra 25,000 now. Okay, so I think I hope this question is clear to everyone. A very nice question. Very similar. I think you have a question in your study module towards the end. So I think that's it from me, guys. It's I've taken extra 5-10 minutes. I hope you don't mind on that. We have done some more practice though. So you guys have almost three to four questions in your notes, guys. What I've already uploaded. So question related to a city clap. One is this, and then there is a couple of questions of Mary Limited and one more question was there, that is in terms of earlier, gamma related questions. So there are two or three questions which are there, which you guys can practice later on, which of course you need. Apart from also, apart from these questions, I would request you guys to ensure that all of you do, all the practice questions of a study material which are given there. Go back to your, RTPs or past year question papers. Make sure that we do not forget our success mantra, right? I hope you remember the 3 shortcuts to the success: practice, practice, and practice. So I will keep on going that, guys, and make sure that you guys continue your hard work. So thanks a lot for joining it in Fantabulous 2 evenings. It was not an evening in Paris, but it were 2 evenings in capital busting. And now I will be meeting you guys almost a week later, I guess on 9th March, if I'm not wrong. We will, in the meantime, of course, you will have your other sessions, but we will have more fun. We meet for another 3 round of sessions when we talk about working capital management towards end. Those will be also very, very important sessions, guys. So have a great learning time, guys. Keep on, doing the good work. So wish you all a good night and a happy learning, guys. Take care and be safe. Cheers. Bye-bye.